Okay, so hello everyone. Welcome to this preview of the Fed meeting, the FOMC meeting. Just for the record, I'm recording this at about 3 p.m. on Tuesday, December the 12th. So just a few hours before the Fed actually releases all of the documents, which will be, of course, tomorrow on Wednesday, the 13th at 2 p.m. Okay, guys, so let's just review where we are. I think it's probably not a bad idea just to sort of understand what's at stake in this meeting. And we know that the Fed hasn't hiked since, I think it was July. So at this point, technically, they've been on hold for 5 or 6 months. And so, the only final question is, will they hike tomorrow? Nobody's expecting that, neither the market nor the Fed. So let's just say that's a 0% of chance. So at this point, we can assume that the hiking cycle is finished. And at this point, it's very simple. There are just two questions. How long will the Fed hold at this level? And secondly, when will they be cutting doing the first cut and begin the cutting cycle? So according to the market, and again, this is what we have to figure out here, because the market is saying one thing, the Fed has said something, and possibly will say another thing tomorrow. So really, the way the market's going to move, on this Fed is really just this sort of interaction between what the market has been expecting and pricing and what the Fed actually is trying to sort of communicate. Okay, so let's first of all look at what the market is saying. And pretty simply, since the last Fed meeting, which was on November the 1st, we can look at that in a second. But basically what's happened here, actually, let's just look at that immediately. So what I've got here, guys, I've got, this is essentially looking at, I'll just put that here. This is looking at the Fed funds rate in terms of implied yield. And I've got three different charts here. So the one which is sort of literally now is the orange one, which you see here. And if you just look at just a couple of days, so which is the blue one, which is just like a couple of days before the last Fed meeting. And this is just a day or so after the Fed meeting is the green one. So what you can see is that going into the Fed meeting, the last one, the market was pricing cuts for sure, absolutely pricing cuts, but they were going to hold up and out until here. And what you can basically see is that going into that meeting, or just after that meeting, everything was priced down. So the market started pricing down where they think the Fed funds meeting, Fed funds rate would be. And also you can see here that the cutting cycle is slightly sort of brought in a little bit and down much more aggressively. So you can see that before the last Fed meeting was sort of, this was going to sort of be up a little bit more, then slowly coming down there. Whereas now it's sort of, downtrending, and it's going to be like that. So pretty simply, what's happened is that the market has repriced everything very dovishly in the last, let's call it 6 weeks or so. And why is that? The market has done that because the narrative now is that the Fed is happy with the way inflation is going. Inflation seems to be slowing down. Earlier this morning, we got CPI, which came in more or less in line, or did it, but let's say more or less in line. And clearly the direction of travel for both the core CPI and, well, actually for the CPI and the core PCE is downwards. And so the logic goes that the Fed will necessarily cut. And we'll see what the logic is for that in a second. But just in terms of the pricing here, let's just look and see what we've got here. So the market is saying, okay, the Fed's not going to do anything this time. It's not going to do anything in January. Oh, I do beg your pardon. Sorry about that. But what the market's basically saying is that there is a 42% chance, let's call it like a 40% chance of actually cutting for the first time in March. And that's come forward, a lot. And then basically the market is saying that by the May, there's 25 basis points is priced in until by the end of next year, 2024, in, let's say, the December meeting, 18th of December, we go from 5.33 Fed funds rate down to 4.23, which is about 112 basis points. That's about 112 basis points, okay? So in simple terms, if we take 25 basis points for each cut, the market is saying the Fed will cut, sometime March or maybe May, but basically by the end of the year, they will have cut, about equivalent to 4.5 cuts, which you see here, 4.3 cuts, okay? Now, is that justified? It could be, it may not. So what would cause that? There are a couple of reasons to look at that. But before we look at some of the reasoning, I just want to also give you a sense of how this has all changed. If we look at, let's say, the March one. So what I'm going to do here is to look at that. And we can basically see, I'll put this on a, what should I do? I'll go back 6 months. I think. Let's see if that's going to work. So, and what you guys can basically see here is that let me just put this. You can see that the market has priced down well, let me just check something here, guys. I'm just want to have a look at this here. Oh yeah, that's the wrong one. That's why that was looking a bit weird. Okay, so what we're seeing here is literally the number of basis points which the market thinks the Fed will be priced at for the March meeting. And what you can see is here is that ever since the March meeting, which is ever since the November meeting, which is around about where are we? Around about here or so. At that point, the market has priced out. I mean, it's gone up a little bit in the last day or two, but basically it's priced out almost 20 basis points. You see how it's been priced down more and more and more aggressively. And as recently as, let's say, the middle of October, you can see that for the March meeting, it was actually a positive number, which is 10 basis points of hikes. Okay, so very simply, what's happened is that in the last 6 weeks, the market has essentially come to the conclusion that the Fed will cut earlier and more aggressively. Okay, now why is that? There's kind of two sort of bits of logic here. One logic is to say, well, you know, the Fed is going to have to cut because we're going into a recession. And as you guys know, that's been a big sort of talking point, this whole idea that the economy is slowing down. And, you know, we're talking about the unemployment rate is meant to be going up, and, you know, non-farm payrolls numbers meant to be coming down, and retail sales is coming down, and everything's slowing down. I personally think that if you look at all the economic data, there is evidence that the economy is slowing, but it's slowing at a very, very, very gradual pace. And so the question really here is to say, well, okay, if the Fed you know, is going to cut 4.5 times, doesn't that imply that there will be a very nasty recession? Yes, that's the answer. Do we have a nasty recession? No. Do we have evidence of a nasty recession? So my first observation is that maybe this market pricing is a little bit optimistic, or let's not say optimistic, is a little bit dovish. But there is another argument, which is very, very interesting. And this is the argument put forward a little bit by Waller and others, like sort of Williams at the Fed. And this is the idea that if we look, and what I'm going to do here is to bring up basically an interesting chart, which has been referenced by people like Waller and others, which basically is saying that the Fed doesn't want to get too restrictive. At this point, we can say that the Fed is saying, well, okay, we have Fed funds rate at a certain point. Now, if inflation comes down and the Fed funds rate is above the rate of inflation, if we do not bring down the Fed funds rate in an equivalent manner, like the rate of inflation falling, then in a de facto way, we are tightening. It's like sort of a stealth tightening. It's like a de facto passive tightening. Okay, it's like tightening by admission. And what I'm trying to say here is that this is the Fed funds rate, midpoint here, which you can see there. This sort of orange line here is the 1-year inflation swap. So it's where the market believes inflation will be in 1 year from now. And as you guys can see, if we go back a while, going back into, you know, let's say 2022, at a certain point that got up to 6%, and you can see that the Fed funds rate was way below. So therefore, the Fed was behind the curve, and the monetary policy was extremely loose and easy. But obviously, the Fed hiked, and at the same time, magically, the inflation rate came down until now. The Fed funds rate, the midpoint, is above the inflation swaps going 1 year out. And we can actually see that that differential is getting higher and higher. And this differential here, which now stands at about 3.4%, for certain members of the Fed, it seems like Waller, maybe Williams of the New York Fed, that is a good way to consider how tight or how loose the Fed's monetary policy is. And by this metric, the Fed is relatively tight, quite tight. And that's actually what Jerome Powell said the other day in one of his speeches. He said that, you know, from his perspective, the Fed is pretty tight. The logic goes as follows for this line of thinking. If the inflation rate continues to fall, necessarily the Fed funds rate should also be reduced. And so the gap, this kind of spread, should be maintained, you know, to be honest, maybe something a bit similar to what it is today. If the inflation rate continues to fall and the Fed funds rate is not cut, according to that school of thought, there will be a de facto tightening, which actually could cause a recession unnecessarily and would be a problem for the Fed. And so by this logic, that's what the market is saying. A lot of market participants and commentators are saying this is the reason. It's almost like a mechanical thing here, that the Fed will cut. They will in essence follow inflation down. And that's one of the reasons which we can justify. The market is justifying 4.5 cuts, basically saying that, you know, inflation will fall, you know, another a little bit, you know, over the next year will continue to come down to the Fed's the Fed's target, and as simple as that. Okay, so that's interesting, but there is another way of looking at that, and just let's look at a few other different graphs here, and to say, well, okay, if that's the case, if we're in a restrictive territory, we do seem to be, financial conditions do seem to have loosened a lot. And you can see here coming down, this is on the Goldman Sachs Financial Conditions Index. That has loosened a lot over the last 4, 5, 6 weeks. We've seen yields coming down. We've seen the US dollar remaining, relatively weak. We've seen equities rallying strongly, even today, rallying even more today. And so the point is that financial conditions have remained are loosening. So we seem to have a dichotomy here. We seem to have two things in sort of, in competition. We have certain members of the Fed saying, hey, maybe we need to cut. The market saying the Fed needs to cut because inflation's coming down and they don't want to be too restrictive. On the other hand, we have financial conditions indicators, and we have the Bloomberg one and the Goldman Sachs one, which is indicating that, saying that financial conditions are weakening. So why would that be? Why would that be? And one sort of school of thought is to say that there's kind of two main players at the moment. Not only do we have the Fed, we also have the US Treasury. And some people are saying, and I think this is very interesting, is that Janet Yellen is kind of in cahoots with the Fed and maybe even with the Biden administration, because remember that she works for the Biden administration and is doing a little bit of stealth QE, or at least balancing out the hawkishness of the Fed. So how is she achieving this? If you guys will remember, when we had the August quarterly refunding announcement, so that's the amount of refunding which the Treasury needs, that shocked the market a little bit, and we had a higher than expected issuance of long-term bonds. Okay, and it's no surprise that at that point we saw that financial. Let's just go back to a couple of charts here. We can see that at that point, what happened? We got the yields. Let's have a look at, let's say, a 30-year bond yield. We can see that this is a daily chart here, if I'm not mistaken. Yeah, just check it's a daily chart. We can see when that happened, and you can look at this here. That's when Janet Yellen issued more long-term bonds than expected. We see that the yields ripped. Equities came off, the curve bear flattened, bear steepened, and financial conditions tightened. And that was when we got the famous comments from, people like Powell and other members of the Fed saying, oh, financial conditions have tightened, the long-term yields going up have kind of done the tightening for us. But what's very, very interesting is that on November the 1st, which just by a crazy coincidence happens to be here, the market was primed and expecting, again, another big issuance of long-term bonds. But very interestingly, Janet Yellen's Treasury declined to do that. And what they did, they actually loaded up with, by issuing a lot of bills, short-term bills. Now, just keep in mind that historically, about 20% of outstanding debt is bills. Bills are about 20% historically. At this point, it was about 60%. So definitely it was a real decision, a specific decision to in terms of all the debt issuance, to shift away from the long end and put everything at the extreme, at the very front of the curve, which would take the pressure off long-term yields. And guess what happened? Long-term yields have absolutely, fallen dramatically. We've had a huge rally in the stocks, and the curve, rather than has actually been flattening again. Well, it's a complex one, but it's been flattening and steepening, flattening and steepening. So at this point, what is and why is that? It's led to lower yields, and that's also been led by the term premium coming down. So the term premium, we can look at that chart as well. The term premium is coming down, and remember, the term premium is the extra kind of yield which bondholders require if they're worried about the stability of the long-term bonds, and that's not the case at the moment. And so what is very interesting here is that on one hand you have a Fed which technically is meant to be having restrictive policy by maintaining these high interest rates, but on the other hand you almost have, like, as I said before, like a bit of a stealth quantitative easing versus the quantitative tightening of the FOMC, because remember that the Fed is doing quantitative tightening as well. So they're maintaining the Fed funds rate at a certain level, but they are also letting, I think it's at $95 billion per month run off. And so they are tightening by having, by buying less long-term bonds. But that QT is being essentially offset by all the bills issuance, or shall we say more accurately, the lack of long-term issuance by the Treasury. It's offsetting it. So therefore the QT is not as hawkish or as restrictive as ordinarily it might be. So the question now is that if the Fed uses the inflation, says, oh, inflation's going down, therefore we just mechanically need to go down in lockstep with it. And let's say the Fed starts to cut, according to the market, remember the Fed has a good chance of cutting maybe as early as March. and we have the Treasury, which at this point is front loading the issuance, is making the issuance front loaded with the front end. That's going to be very, very loose for financial conditions. And the interesting thing there is that if financial conditions remain loose, a weakish US dollar, low long-term yields, a powerful stock market, or a stock market nearly at all-time highs, what does that mean? Does that not mean that inflation may have a chance to kind of push up a little bit again? And this is very, very interesting. And for example, today, everyone was essentially saying that the CPI today was, in line, and to a degree it was. But keep in mind that the core is at still 0.4% month over month from memory. That implies, if you annualize that, something, in the fours. And the other thing as well, which is interesting, is that Jerome Powell has the core services ex shelter, which is a very important number for Jerome Powell. Core services excluding housing and shelter. That was at 44 basis points today, 0.44. If we annualize that, that's almost, what's that, 4.85%. That doesn't sound like a 2% target for me. The point I'm trying to make is that it's quite interesting to me, and there is a case to be made that the Fed, I would say, at a minimum, may communicate fairly hawkishly tomorrow, and in reality may not actually cut as soon as the market thinks. So that's all quite interesting. So how are we going to interpret what the Fed's trying to communicate? And again, we don't know exactly what the Fed is thinking. Is the Fed saying, yep, inflation seems to be more or less going down. There's an election coming up in 12 months. We don't want to be doing anything nasty in 8, 9, 10 months. So let's maybe cut earlier than we ordinarily would like to, because we don't want to be seen to be cutting for Joe Biden going into an election cycle. So there are those political angles as well. So I think the way to look at this is just to see whether the Fed, how they communicate. And I think that's the way really the market is going to trade. So first of all, let's look at the statement. So this is the statement from November. And remember that the previous meeting was the last time we got the summary of economic projections. But let's look at the statement. And it's clear here that, if they change it, inflation remains elevated, or will they say that inflation has moderated somewhat? The other thing here is about financial conditions in the second paragraph. Will they are likely to say the tighter financial conditions? I mean, it's a curious one, because if you look at, let's say, for example, indicators like the Goldman Sachs index or the Bloomberg index, financial conditions have clearly loosened, not tightened, since this statement. So will they say, financial credit conditions have loosened since our last statement? And are they continuing to weigh on economic activity? Who knows? To me, that seems kind of interesting. The other thing as well is, which is going to be absolutely critical. We've had this sentence in for many, many months now, in determining the extent of additional policy firming that may be appropriate. Will they completely jettison this phrasing here? Will they just lose this phrasing here? I mean, who says they need additional policy firming? Will they change it and saying, in determining whether additional policy firming may be appropriate? This is the key one here. I don't believe that they'll change their QT. There's not really much need for them, or I don't think they will do that here. So I think that's going to be very, very important to look at that. And then, of course, probably the most important thing, in fact, by far, apart from the press conference, will really be, this updated summary of economic projections, the SEP. Okay, so let's look at the numbers here. First of all, guys, the headline inflation, maybe forget. So let's look at these numbers here. So let's first of all see the real GDP back in September. They had it at 1.5. So the question here is, will that go down to maybe 1.4? Will they try and indicate a little bit that, they believe the economy over 2024 will weaken a little bit? If they keep that at 1.5 or even raise it higher, that would be very hawkish to say that they don't at all believe in a recession. If they don't believe in a recession, in what world would they need to be cutting interest rates? So we have to assume they're going to put that down to maybe 1.4. Anything less than that, 1.3, 1.2, is maybe trying to indicate that they believe, a recession is somehow coming. The only other thing here is the unemployment rate. And keep in mind, 3 or 4 days ago, we got 3.7. So absolutely, for sure, didn't get to the 3.8 end of 23. So one would assume that the unemployment rate you know, they're going to have to change this. One would assume if they believe that, you know, they have to sort of tighten financial conditions a bit, that the economy might go a little bit into recession. One would assume that would have to go up to 4.2 or maybe 4.3. If they were to keep that low, that would be, you know, extremely optimistic, essentially saying that they, you know, don't believe that, you know, they're going to cause more unemployment and that the economy will go into any kind of recession. And then, of course, is the core PCE. And we have to believe that if they do believe that they'll be cutting interest rates, that this has to be revised down from, let's say, 2.6, maybe something like 2.4 or something like that. Anything less than that, I mean, that would be nonsensical. So we have to assume that, you know, that would be revised down to 2.4. But really, the one which is going to get all of the market's attention, and this is, I think, is going to be the main thing to be trading around which the market will be trading, is where the dot plot, the median Fed funds rate will be. Now, as you guys can see in the last SEP here, it was at 5.1, technically 5.125. Okay, so between 5 and 5.25 is 12.5 basis points, so 5.125, which they write as 5.1. But the real number there is 5.125, or 5 and 12.5. Okay. So what they're basically saying here is that at their last, you know, summary of economic projections, they were signaling 2 cuts. Okay, from 5.6 to 5.1 by the end of 2024, median. Okay, 2 cuts. Now, if we assume, and it will be a massive surprise, if we assume that they do not hike in, well, tomorrow in December, automatically we need to subtract 25 basis points. Okay, so it's 25 basis points that we're going to go 5.12 subtract 25. But really what we need to probably do is to say, well, you know, maybe this number is going to be revised down to something like 4.7. So why would that be? If they do 4 point, so, you know, and again, we need to go back and just see where it is now. So let's just see where the effective Fed funds rate is now. I think it's about 5.3-ish, something like that. Yeah, so we've got 5.33. That's the effective funds rate today. So if we just go back here and you know, and we look, actually, sorry, what I want to do, I need to go back. Okay, so we see here that at the moment it's 5.33. And as we see, the market is saying it's going to be about, you know, 4.22, 4.23, 4.24 by the end of December. What is the market saying? The market is saying that the Fed is going to cut, as we said, by about 112 basis points. Let's call it about 4.5 cuts, okay? So this is the first thing which is kind of going to be interesting, is because the market at this point is saying, okay, you guys have to, you're not going to hike tomorrow. You need to cut by, you know, 112 basis points. So presumably for the market, this number needs to come down to about 4 to match the market expectations. Okay. But the thing is that if you look at the Taylor rule, and I'm not going to go into detail, but if you look at, just apply the mechanics of the Taylor rule, which is the Fed really at this point, if you look at all the metrics of the unemployment rate and everything like that, really what they're probably looking for is, you know, maybe about 4.7. That's probably what they should do, is to say 4.7. And what that basically means is to say, well, okay, you know, that's going to be down. So that's 40 basis points compared to, you know, reduction from the last SEP here. So we take out 25, of course they didn't hike. So essentially that's about, you know, 15 basis points just to readjust for the Taylor rule. Okay. What message would that send? That would therefore say that the Fed is saying that, you know, they have no intention of cutting nearly as much as the market, and that would be perceived as hawkish. So the first thing I want to say is that the first thing you need to be looking at is the median dot for 24. Anything 4.7 and above is hawkish. Now, will the market believe that? That's another question. But the point is that's definitely a communication by the Fed that they are not cutting as much. What would be dovish? I would say the closer that goes to 4 is to echo the market. So anything, obviously, something like 4 would completely endorse the market, the market pricing. But in my humble opinion, that would be extraordinarily counterproductive, because essentially the market would run with that and say the Fed's done. The Fed is going to be cutting 4 or 5 times next year. We would have an explosion at the front end of the curve. We would see a massive bull steepening. Gold would sell off, the dollar would sell off, bonds would rally, especially the front end, the stocks would have a crazy rally, it would massively, massively loosen financial conditions. And to get back to the arguments before, that would potentially reignite a second wave of inflation, which presumably is the last thing the Fed wants. So I think what's going to be extremely interesting tomorrow is the Fed is going to try and navigate between being hawkish, but maybe giving a little bit to the market. So I think something like 4 would be absolutely crazily dovish. They necessarily have to subtract 25 basis points. So you've got to say that, what would that be? So that would be, let's say about 4.8 would be, I would say, the most hawkish possible. So 4.7, I think is probably reasonable. Again, if they come in with something like, sort of 4.5, 4.25, that I think is, relatively dovish, and that will signal to the market that the Fed is not completely pushing back or on the market pricing. So that's really what you need to be looking out for tomorrow. Now, in terms of the press conference, of course, obviously Powell's going to be asked about this thing like the Taylor rule, this whole idea that or not the Taylor rule, but this whole idea that, the Fed funds rate, if inflation is seen to be going down, does the Fed funds rate necessarily have to follow in lockstep to maintain an equivalent degree of restrictiveness? That's one thing. Let's see what Powell says about that. Secondly, this whole interaction between the US Treasury, which is not doing long-term bond issuance, but is front-loading with bills, versus the QT. Is there any sense for Jerome Powell that Janet Yellen is essentially kind of loosening financial policy to help Joe Biden, while the Fed is trying to sort of tighten through doing quantitative tightening? That's going to be quite interesting. Of course, Powell's going to be asked on what time frame and the conditions necessary to cause him to cut. And the other issue as well is that, is it possible, does Jerome Powell think that we can cut, or they can cut, even without a recession? Because some people have been saying, well, okay, if there's not going to be a recession or any kind of serious recession, why do they need to cut? Why don't they just keep the Fed funds rate where it is? So it's quite interesting, because one of the presuppositions with the market pricing at the moment is that either there'll be a strong recession, or B, there's this kind of mechanical thing that somehow inflation is just going to keep on going down. Although what we've been seeing is that the core inflation is actually finding it difficult to go down. And maybe this could be a good moment, guys, because we had the CPI today. Let's just actually have a quick look here at what I'm going to do here is just to put up the core CPI. Let's see if I can bring that up. So this is ex-food and energy month over month. So what we're going to do here, I'm going to put that as a as a chart. Hopefully that'll come up. Yeah, and what you guys can see here is that it's not really collapsing. It's still in the 2s and the 3s. Now, if you annualize that, we get to sort of 3.6 or 4, depending on which way you look at it. So that's that one. But whereas if we look at the headline, I'm just kind of curious here to look at the headline number, which is this one. You can see that it's coming down much more, 0.1 versus the core, and especially core services is 0.44 today. So my point is, some people are saying, hey, the easy work's been done. The Fed got inflation down from whatever it was, 7 or 8% down to this, but now it's going to be stuck. We still have issues. Global supply chains are very, very different. We have a lot of onshoring. Labor costs in China are a lot more expensive than they were, 2, 3, 4, 5 years ago, et cetera, et cetera, et cetera, et cetera. Whereas today, for example, we had Janet Yellen saying, no, I think there's no reason really that the core inflation can't just keep on going down. We shall see. But all that to say that Jerome Powell is going to be grilled about that. And I do believe I cannot see any real upside for him in being extra dovish and completely agreeing with market pricing. I think he really needs to push back relatively hard. But on the other hand, who cares what I think? It's not really about what we think. The main thing is to start looking at some of the markets here and say, well, okay, is there anything which is overpriced? And one thing I am looking at, for example, and you can see this in something like the SOFR spreads. So if you look at let's look at something like this, December 23 to December 24. And you can see here that at the last FOMC meeting, November the 1st, you see at that point, only about 75 basis points was priced in for the 2024, which is more or less what this covers. And then you can see we had this crazy kind of dovish repricing going all the way down to 140 basis points. I mean, subsequently, it's tightened up a little bit, but still, that's the last FOMC meeting compared to now. So the market really tomorrow, is Jerome Powell going to say, yep, that's it, guys, we're definitely going to be cutting, 112, 115 basis points next year? Or will he try and get this a little tighter, just up to, 100 or like into the 70s, 80s, 90s here, just to make sure, especially considering that the labor market is strong, the real economy seems pretty strong, even though it's weakening a little bit. Maybe he just wants to keep things a little tight and absolutely at all costs avoid a premature loosening, just to keep on pushing, especially on that core services inflation. That is what I suspect he should do. On the other hand, does he want to take some kind of victory lap and say, well, guys, things are doing pretty well, we're relatively happy, etc., etc. I do believe if that's the case, the market will scream lower here and will start pricing in maybe, God knows, who knows, like 5, even 6 sort of cuts. I believe that if he doesn't push back aggressively, we could see a bit of a sort of a run up. We could maybe see gold having a little bit of a a run higher, and of course the equities, which we're just looking at here. We can see the equities here. Look at that, pushing to, I'm not going to say all-time highs here because we're not there yet, but look at the equities, just will continue to push higher. We'll see the NASDAQ, breaking out, pushing much higher, trying to push up to all-time highs. And what we would see the front end of the curve. And let me just get the curve here. We would probably see like the 2-year and RIP. We would see all bonds go up, but obviously the 2-year would go a lot more, and we'd see like a bull steepening of the curve. If Jerome Powell wants to avoid that, he needs to push back aggressively. So that's about all I have to say there. I think the only issue for me, which is quite interesting, is the following. I'm going to leave you with this thought. Let's say the dots come in relatively hawkish, 4.7 for 2024, or maybe 4.6, something like that. The market sells off. But let's say, for example, in the press conference, Jerome Powell is not necessarily massively hawkish. So let's say we get a sell-off. Let's say the SOFR, the short-term interest rates sell off, but the 2-year sells off. We get some kind of bear flattening of the curve. We get gold collapsing. We get the dollar ripping. We get let's say the NASDAQ selling off. Will the market then say, okay, that's it. That's definitely sort of peak hawkishness and peak pushback from Jerome Powell? And will then the market say, hey, we're getting to a point where this is almost the last opportunity to really get in on, sort of the whole new cycle, which we might see in 2024. And we could actually see a relatively fast and aggressive buyback, by which I mean, if the market sells off on a hawkish pushback or hawkish dots within 12, 24, 36, 48 hours, where we suddenly see a bit of a steepening of the curve, where we'll see maybe gold being supported, where we see the equities being bought on a dip, we will see the dollar actually being sold on some kind of rally. That, I think, is going to be extremely interesting. And I think, to be honest, obviously we're going into the holiday period. We don't have another Fed meeting until January. We've just had, a lot of data. We don't really have a lot of data for the next few weeks. That's going to be extremely interesting as we go into, as I say, the holiday period. And so we all need to be looking and listening, rather. We need to be looking at those dot plots very, very carefully. And I, for one, if they're a little bit hawkish, will be trying to figure out if there's going to be some kind of buy the dip opportunity. And on the other hand, if Jerome Powell doesn't push back in a hawkish way, I think we could see a pretty aggressive, dovish sort of rally. Okay, I'll leave it there, guys. Good luck, but be looking at that dot plot, the 2024 median, and obviously Jerome Powell's press conference is going to be key. Thanks. I hope that was useful. Good luck.